Hello, welcome to Module 7, Accounting and Reporting for Corporations. Now, let's continue. What's a corporation? What is a corporation? To get the definition, you got to go back to 1819. In 1819, Chief Justice John Marshall defined a corporation as an artificial being, invisible, intangible, and existing only in contemplation of law. So, keywords: a corporation is invisible, intangible, and it exists only in the law. This definition is the foundation for the prevailing legal interpretation that a corporation is an entity separate and distinct from the owners. That's very important. From the legal viewpoint, a corporation is considered a living, breathing person, but a separate entity in itself, distinct from the owners. What are the key characteristics of a corporation? I'm going to break this down. We're first going to talk about key characteristics. Then we're going to talk about the types of stock issued. Then we're going to talk about the types of financial statements issued by corporations. And finally, in the next module, how do you analyze the financial statements of corporations? So let's talk by starting off with key characteristics. As you can see, the first key characteristic is separate legal existence. As an entity which is separate and distinct from the owners, the corporation acts under its own name rather than the name of the stockholders. For example, Microsoft acts in its own name. It doesn't act in the name of Bill Gates because the law sees Microsoft as a separate, living, breathing entity. So, example, Ford Motor Company may buy, own, and sell property. It may borrow money, and it can enter into legally binding contracts in its own name. It can also sue or be sued and pay its own taxes. Let's look at the next one in front of you. Limited liability of stockholders. Since a corporation is a separate legal entity, creditors can only go after the corporate assets of the company. Let me emphasize, they can only go after company assets. They can't go after personal assets of the owners. Repeat, people who sue can't go after the personal assets of the owners. So the liability of stockholders is only limited to their investment in the corporation. That's all they lose. So for example, if you invested $100 in a corporation, that's all you lose. Nothing more, nothing less. The third in front of you is transferable ownership rights. Ownership of a corporation is held in shares of capital stock. These are transferable units. This means that stockholders may dispose all or part of their interest in a corporation simply by selling their stock, and they're done. They don't have to get permission from the corporation to do that. What's the next one? Continuous life. The life of a corporation is stated in its charter. The life may be perpetual, or it may be limited to a number of years. If in the charter the life is limited to a number of years, the life can be extended through renewal of the charter. Think about this. The characteristics I told you, are they advantageous or disadvantageous? Stop and think about it a minute. They are all advantages. Unfortunately, there are disadvantages too, and two main disadvantages are government regulation and additional taxes. Let's take the first one, government regulation. A corporation is subject to numerous state and federal regulations. Most publicly held corporations are required to make extensive, and I mean extensive, disclosure of their financial affairs to the Securities and Exchange Commission. How? Through quarterly and annual reports. Of course, corporations also have to follow all the laws. Do you remember? It's called generally accepted accounting principles. They got to follow all those laws too. What else? Taxes. That's a major problem for a corporation. A corporation faces additional, keyword, extra, additional taxes relative to other forms of business. How? First, the owner's share of earnings from these organizations is reported on his or her personal income tax return. So the individual pay taxes on that amount. That's number one. Number two, corporations, because they're considered a separate legal entity, have to pay federal and state income taxes. These taxes are substantial. They can amount to more than 40% of taxable income. In addition, stockholders are required to pay taxes on cash dividends. Thus, many argue that corporate income is taxed twice. It's called double taxation. Once at the corporate level and again at the individual level. How does a corporation raise money? A corporation can raise money by issuing two types of stock. They're called common stock and preferred stock. Let's talk about common stock first. Common stockholders have the right to vote in the election of board of directors. Common stockholders have the right to share a company's earnings. They are paid dividends from company profits. 3, they have the right to keep the same percentage ownership when new shares of stock are issued. This is called a preemptive right. 4th, they have the right to share in assets upon liquidation. So when the company goes bankrupt, you can share in the assets in proportion to your holdings. This is called a residual claim because owners are paid with assets that are remaining after all claims have been paid. I do want to emphasize that this is only in the United States and Western countries. This is not necessarily the case in Asia. For example, in Japan, stockholders are considered to be far less important to a corporation than employees. Their stockholders are rarely asked to vote on an issue. They are also paid very low dividends. This appears to be the case in France and Germany too. But in the US and UK, stockholders are considered important. Corporations raise most of their capital. I'm talking about millions and billions of dollars by issuing stock to shareholders. Germany, France, and Japan have the opposite philosophy. The bulk of their financing is from large banks or other institutions. Before we proceed, there are certain terms that's essential for you to know. This will come in very useful later. The first is a term you'll see when you look at balance sheet. It's called authorized stock. This is the amount of stock that a corporation is authorized to sell. Issuance of stock. You'll see two terms when you look at a balance sheet. First is par value. This is the price determined by a corporation. Is this high or low? It's generally low. It's the price determined by a corporation when the corporation is newly formed. At that point, nobody knows the corporation. So the par value or the initial price is always low. $1, $5, maybe 10, but that's it. Market value. This is the price the shares can be sold for in stock exchanges such as the New York Stock Exchange. Let's talk another key term. Paid in capital. This is the total amount of cash paid to the corporation by stockholders in exchange for stock. This is another term you'll see over and over again before we finish this course. Retained earnings. This is the net income or profit that's retained in the corporation. Every year, if the company makes a profit, the bottom line profit, is taken and put in a special account called retained earnings. So retained earnings should increase every year if the company makes profits, because every year the bottom line profit is put in retained earnings. This is important. Remember, only dividends are paid out of retained earnings. I'll repeat, only dividends are paid out of retained earnings. So there's an important formula you need to know. To figure out the retained earnings balance at the end of the year, you take the retained earnings balance at the start of the year, add the profit for the year. This is the bottom line profit from the income statement. Then you minus dividends paid, if the company has paid dividends, and you get the retained earnings balance at the end of the year. Let's go on to the next section. Issuing common stock. This is important for you to know. When you issue common stock, what accounts are affected and how is it recorded? Have a look at this problem. Let's take a name. Assume Seinfeld Company issues 1,000 shares of $1 par value, and they issue it for $5 a share. Because on the New York Stock Exchange, even though they decided the price at $1, people were willing to offer $5. How is this accounted for? Take a few minutes of your time and think about it. Have you thought about it? Here goes. You received how much? $5,000 cash. How much stock did you issue? 1,000 shares of $1. So 1,000 common stock. If you issued $1,000 worth of common stock and you got $5,000 cash, you made a profit on the deal. When you issue common stock and make a profit, it's called a special name. It's called paid in capital excess of par. So just remember that. When you issue common stock and you make a profit, it's called paid in capital excess of par. What's a double entry? Accounting is all about double entries. So how is this impacted? Well, cash is impacted because you got cash. Common stock is impacted. And if you made a profit, paid in capital excess of par is impacted. Take a few minutes of your time, write out the T accounts in front of you and put in the signs. If you want, stop this recording and do it. Okay, let's start. Just remember, cash is an asset, so it's plus minus. Common stock is considered a liability from the accounting viewpoint, so liability is minus plus. Paid in capital excess of par is considered a liability because the corporation has to pay the stockholders, so it's minus plus. So now put in the signs, which is cash plus minus, common stock minus plus, paid in capital excess of par minus plus. Cash increases, common stock increases, and you made a profit. So paid in capital excess of par is plus. So everything is plus. So the transaction should look like this. Cash debit 5,000, common stock credit 1,000, paid in capital excess of par credit 4,000. And the beauty of the system is the left entry always equals the right entries. So the total of the left entry is 5,000. The total of the right entries is 5,000. So they always equal. How is this shown on the balance sheet? If you remember, what do you call it? Stockholders' equity. So under stockholders' equity, you'd say, I have common stock issued 1,000. You made a profit. Paid in capital excess of par is 4,000. And the total money you received, which is called total paid in capital, 5,000. So that's how you break it down. You have it under stockholders' equity. You say common stock, 1,000. Paid in capital excess of par, 4,000. And then you add it up and you say total paid in capital, 5,000. Let's look at the balance sheet for a minute. There's assets, liabilities, stockholders' equity. Assets are on the left, liabilities and stockholders' equity on the right. You remember this? We did this before. Stockholders' equity, let me build up on it, has common stock. You show paid in capital, excess of par. Then you get the total paid in capital, which is the total money you received from stockholders. Then you show retained earnings, which is the total profit the company's made every year. The total bottom line profit. And if you add that up, you get the total stockholders' equity. What does that mean? If the company were to go bankrupt, this is the stockholders' stake in the company. Now, this is where it gets important. A corporation has to do 4 types of financial statements. What are they? An income statement, we did this before, except in a corporation, it has to be done in a special format, which we haven't done. It's called the multiple step format. Then you have to do a statement of stockholders' equity. What did you call it before? If it's a sole proprietor or any other form of business, you call it statement of owner's equity. But in a corporation, you call it statement of stockholders' equity. Then you do the balance sheet. We did a balance sheet before, do you remember? Now the balance sheet has to be prepared in a special way. It's called the classified format. And then you do a statement of cash flows. The statement of cash flows is the subject of our next module. So let's start with each one of them. Let's start with the income statement. We're going to do this for a hypothetical company called Seinfeld Company. You start with sales revenue, which is 100,000. In this hypothetical example, I just put in 100,000. you have to deduct sales returns and sales discounts. So let's put a number. Sales returns 1,000, discounts 3,000. Then you arrive at the net sales, which is 96,000. Now you deduct cost of goods sold. So in this case, assume cost of goods sold is 45,000. Cost of goods sold is basically what you bought the goods for. If it's 45,000, as in this case, it means that the goods cost the company 45,000, but they got 96,000 for it. The difference between sales and cost of goods sold is called a name. It's called gross profit. Once you arrive at the gross profit, you deduct operating expenses. These are the regular expenses incurred to run the business. Can you give me examples of operating expenses? That's regular expenses incurred to run the business. Think about it. Examples are salaries, rent, utilities, advertising, insurance, and so on. So I put in an example of operating expenses. After you deduct operating expenses, there's a name. So gross profit, then you knock off operating expenses. So gross profit minus operating expenses is called a name. It's called income from operations. Now you add other revenue and subtract other expenses. Other revenue is any revenue other than sales. So, for example, if the company invested extra money and obtained interest, that would comprise other revenue. In this case, let's put a hypothetical number, say 10,000. Other expenses are any expenses incurred which don't, keyword, don't relate to the daily operation of the business. Examples of other expenses include write-down of obsolete inventory, losses due to strike by employees, and so on. So you add other revenue to income from operations, you subtract other expenses, and you arrive at the net income. This is the net income before tax. Then the IRS would come and say, pay taxes on the net income. Now, let's look at the statement of stockholders' equity. For this company, I put in hypothetical numbers. Let's say common stock is 10, paid in capital is 50, total paid in capital then would be 60. Let's say the retained earnings is 38.5, so the total stockholders' equity would be 98.5. These are hypothetical numbers. I just made it up to give you a feel for it. How do you get retained earnings? Remember this formula. Retained, to get the ending balance is equal to beginning retained earnings plus profit less dividends. So let's say the beginning was 20. This year they made 28,000 profit. So the total in the retained earnings should have been 48. Assume they paid 9,500 dividends. So your ending balance is your beginning plus your profit less your dividends, which is 38,500. Now we come to the most important section. For corporations, when you do the next one, which is a balance sheet, it has to be in what's called a classified format. What does that mean? Let's go to basics. When you do a balance sheet, you show assets, you show liabilities, and we used to call it owner's equity, but it's stockholders' equity. Under assets, you have short-term assets, current assets. Remember, short-term assets are called current assets. They include inventory, accounts receivable, cash, and so on. Then you have long-term assets, but you don't call it long-term assets. You stick it in a special category called property, plant, and equipment. The commonality of current assets and the long-term assets is that you can see it, you can touch it, you can feel it, perhaps you can even smell it. There are other types of assets you can't see, touch, or feel. These come under this group called intangible assets. Can you think of an intangible asset? Patents or patents, depending on whether you're British or American. Patent is an asset which is you can't see, touch, or feel, but it's an asset. That's an example of an intangible asset. Under liabilities, we got short-term, which is called current, and long-term. Then you have the stockholders' equity. And when you add up the assets and on the right side, the liabilities and stockholders' equity, they should balance. But what does this word classified mean? In a classified balance sheet, the only thing you got to remember is that current assets are shown in order of liquidity. What does liquidity mean? It means how easily can you convert this to cash. Now think about this. In front of you, you got two current assets, which is accounts receivable and inventory. Which is the most liquid? Take your time and think about it. If you want to, stop this presentation and rank them. And when you're done, you can restart. Have you thought about it? The answer is accounts receivable. Accounts receivable is more liquid than inventory. Think about it. How many steps before you convert accounts receivable to cash? Just one. The customer pays you and you got cash. So one step. Now, think of inventory. How many steps before you can convert to cash? Well, you got two steps. You have to sell the inventory. Assuming you sell it on account, which is what most businesses do, then it gets converted to accounts receivable. Now you get cash from accounts receivable. So there are two steps. So in a classified balance sheet, account receivable goes ahead of inventory. Now look at the next exercise. Arrange these in order of liquidity. you've got inventory, you've got marketable securities, which is stocks in other companies, you've got cash, you've got prepaid expense, and accounts receivable. I want you to arrange this in order of liquidity, which means put number 1 for the most liquid and rank, so number 5 would be the least liquid. Have a crack at it. Stop this presentation and try it, and when you're done, restart and I'll give you the answer. Are you done? Here's the answer. Did you get it? Cash is number 1, the most liquid. Number 2 is marketable securities. It's very easy to sell your stock and get cash. You may not get what you want, but it's still easy. All you do is pick up the phone and call your stockbroker. Accounts receivable is number 3. Now you have a problem between inventory and prepaid expense. Generally, it's assumed that when you prepay, it's really difficult to get the cash back. So prepaid expense is always ranked last because it's considered to be the least liquid. So inventory would be number 4 and prepaid expense would be number 5. Now, let me show you a hypothetical balance sheet. You have done balance sheets before, but when it's classified, let's start again. You show assets, liabilities, stockholders' equity. Then in assets, you got current assets. You got property, plant, and equipment. You got intangible assets. The only difference between this and what you did before is that the current assets have to be ranked in order of liquidity. So that's the only difference. Everything else is the same. So it's not that bad, is it? So I put in hypothetical numbers, but cash is always put as number 1. Then you got accounts receivable, then you got inventory and prepaid insurance, which is always last. Then you would say equipment less accumulated depreciation and get the total. You would stick in intangible assets, and then you're done with the asset column. Then you go to the liabilities and show current liabilities, and I put in 2 examples, note payable, account payable, and I put in hypothetical numbers. Then you show long-term liabilities, example mortgage. Then you show the total of the stockholders' equity, and you total it, and the left side and the right side should balance. Now you know how to do an income statement, which has to be in multiple step format. You know how to do a statement of stockholders' equity, and you know how to do a balance sheet in the classified format. This concludes Module 7.